Welcome back to the deep dive. So, if you've been following the business news at all this month, you know there's this huge financial foundation being built.
And it has a name, AI infrastructure.
Exactly. This isn't just, another spending cycle. It's a massive foundational capital commitment. And today, we're taking a critical deep dive into three major players who just reported earnings.
Broadcom, Synopsys, and Oracle.
Each one gives us a completely unique view into where the money's flowing and what the financial consequences really are for building out this global AI capacity.
That's exactly right. We're looking at three really distinct roles in the AI supply chain. You've got Broadcom, the hardware supplier.
Right.
Then Oracle, the cloud infrastructure builder. And Synopsys, the specialized design tool enabler. Our mission is to sort of synthesize their latest financial reports and strategic positions to give you the clearest picture of this gold rush.
Okay.
And, of course, the crucial non-negotiable disclaimer, which we always have to stress.
Of course.
This discussion is based purely on publicly available reports. It's for informational purposes only, is not financial advice. We really encourage you to perform your own detailed research.
And understand your own risk profile, duly noted. Okay, let's unpack this. And since we're talking about massive growth, let's start with the company building the actual silicon.
Broadcom.
Broadcom, they are leading the charge for immediate, high-margin AI delivery.
Yeah, Broadcom's performance was, well, it was exceptional, especially when you see how dominant AI revenue has become for them.
Exceptional is the right word. They blew past expectations for Q4, reporting a record $18.0 billion in revenue. That's a 28% jump year over year.
And then the guidance is just as strong.
Just as strong. They're looking at $19.1 billion for Q1 of fiscal 26, which is another 28% year-over-year growth projection. I mean, this is acceleration at a scale you just rarely see.
Especially in hardware.
Especially in hardware.
And when you look for the engine driving that, it is purely AI. Their AI semiconductor revenue surged 74% in Q4.
74%.
And it's projected to nearly double in Q1. I mean, it could hit $8.2 billion.
Yeah.
This isn't just about components anymore. This is specialized custom silicon.
Okay, let's pause on that. Specialized silicon. They talk a lot about their custom AI accelerators, the XPUs, and their high-end networking switches like the Tomahawk 6. For someone listening, why is custom silicon so critical? Why does it give them what people call a wide economic moat?
Well, it creates a structural barrier to entry. Broadcom is making chips and systems that are custom designed for a few massive hyperscalers.
We're talking Google, Meta, Microsoft.
Exactly. These aren't off-the-shelf parts you can just buy. They're deeply integrated into the customer's own software, their own architecture. And once those customers are locked in, well, the switching cost is just astronomically high.
Which gives Broadcom pricing power.
Pricing power and immense revenue visibility.
And that visibility it's huge. They reported this absolutely massive AI backlog, so committed future orders of over $73 billion.
$73 billion.
That includes the big one everyone was talking about, the $11 billion order from Anthropic. What does a backlog number like that actually mean for the business?
It means guaranteed inertia. I mean, a backlog of that size basically makes them immune to macroeconomic swings for, the next 18 months in that segment. They know exactly what they need to make, and they know who's paying for it. It's like a fortress of future revenue.
Okay, so here's the fascinating kind of counterintuitive part. If the growth is stellar, the chips are a fortress, the backlog is huge, why did the stock slide after they reported earnings? This is where the tension comes in.
Right. The market fixated on this nuance of margin compression. Broadcom's consolidated gross margin is still excellent. It's around 67.77%. But the company projected a sequential decline in Q1.
And why?
It's because the increasing mix of those high-demand AI system sales includes what they call pass-through costs.
Pass-through costs. Can you break that down simply for us?
Sure. Think of it like this. When Broadcom sells a specialized AI system, they're bundling their own high-margin chip, the engine they designed, with very expensive, necessary components from third parties.
Like high bandwidth memory, HBM?
Exactly. Primarily HBM.
Yeah.
And they pass the cost of that HBM straight through to the customer with little or no markup.
So it's like you're selling custom high-performance engines. Your profit on the engine itself is huge. But if you have to bundle expensive third-party premium tires at cost with every engine,
your overall profit percentage on the total package shrinks, even though you're selling more engines than ever.
You're selling more product, but at a slightly lower blended margin.
And the market hates any sign of margin erosion, even when it's volume-driven. There's also the other concern that AI spending is, sucking the oxygen out of the room for everything else.
Meaning hyperscalers are putting all their cash into AI capacity and less into traditional enterprise gear. So Broadcom is managing these short-term margin risks against a really high valuation, trailing PE of 83, forward PA of 43, and pretty significant net debt. They're delivering phenomenal cash flow now, but the market's pricing in perfection.
That's the picture. High margins, high valuation, and very sensitive to any cost changes.
Okay, so if Broadcom is the high-margin supplier winning the component war, who's actually spending the massive capital to build the cloud for them, that brings us to Oracle, a completely different story, a capital-heavy conundrum.
Oracle is in the middle of a phenomenal strategic shift. I mean, they are aggressively transforming into a major AI cloud provider, OCI. Their total cloud revenue hit $8.0 billion, up 33%.
But the real jaw-dropper was the IS number.
Right. Infrastructure as a service revenue soared 66%, and their GPU-related revenue. That grew an eye-watering 177%. That number tells you everything. It tells you Oracle is successfully attracting the customers who need immense compute power.
But the real story here isn't what they earned last quarter. It's the massive contracts they've secured for the future. We have to talk about RPO.
All right, RPO, remaining performance obligations. This is money that customers have already contractually committed to paying Oracle in the future. And Oracle's RPO, it surged an incredible 433% year over year.
433%.
Hitting $523.3 billion. That figure alone guarantees substantial future revenue from clients like Meta and NVIDIA.
That kind of surge is historic. What's their moat? What's their competitive advantage while they try to fulfill this gigantic commitment?
It's really twofold. First, high switching costs from their integrated application suites. Second, and this is key, flexibility. Their OCI architecture is high performance, and they have this unique ability to offer their databases across competing hyperscalers, AWS, Azure, Google Cloud, with consistent pricing.
That multi-cloud strategy makes them very sticky.
Very sticky, especially when you combine it with innovations like their new AI database.
Okay, now for the financial stress test. The future RPO is huge, but the cash flow statement, it raised some serious alarms. Operating cash flow was positive, but their free cash flow for the last 12 months turned heavily negative.
Nearly negative $13.18 billion. Oracle is currently burning cash aggressively.
Why? Why the massive shift?
It's purely down to capital expenditures.
Yeah.
CapEx. Oracle announced they plan for their full FY26 CapEx to be about $15 billion higher than they previously forecasted.
15 billion more.
They're accelerating spending dramatically because they have to. They need to build the data centers and buy the equipment, all those GPUs and servers, to meet that $523 billion RPO commitment.
So let me get this straight. They secured the sales, but now they're sacrificing near-term cash, leveraging debt, and essentially betting the entire farm on their ability to build that capacity fast enough.
Absolutely. It's the high-risk, high-reward approach to the AI boom. They're choosing future market share over current free cash flow. This strategy, combined with some bad press.
The allegations of OpenAI data center delays, which they denied.
Right, and the announced securities fraud investigation. It's all led to significant scrutiny and volatility in their stock.
That raises a big question then. If they're relying on debt and negative cash flow to build this, is that CapEx a liability or is it a strategic asset? What happens if that demand curve flattens even a little bit?
Well, Oracle's position is that this CapEx is a strategic investment in revenue-generating equipment. They believe these investments will quickly convert that massive RPO into real revenue. They've also committed to maintaining an investment-grade debt rating despite a high debt-to-equity ratio of 4.08.
So they think the ROI timeline is short.
It's a pure execution risk story. If they build it, the RPO guarantees the customers will come. But if they don't build it fast enough or the costs get out of control, they have a serious problem.
A truly capital-intensive gamble. Okay, let's pivot to our third player, Synopsys. They're a different kind of builder. They don't make the chips like Broadcom or run the cloud like Oracle.
They make the sophisticated tools that design the chips in the first place.
This is the specialized infrastructure play.
And Synopsys is the undisputed leader in electronic design automation, EDA. They reported record annual revenue of $7.05 billion and gave strong guidance for FY26. Their momentum is all about a massive strategic transformation.
And that transformation is the game-changing acquisition of Ansys, right?
That's the strategic engine. The Ansys deal transformed Synopsys from a pure EDA leader, a company that just provides software to design chips, to a silicon-to-systems solutions provider. ANSYS specializes in simulation and verification.
Which is becoming more important as chips get more complex.
Incredibly important. With things like 3D IC and advanced packaging, design complexity is now a major bottleneck.
So instead of just drawing the blueprint, they now also provide the structural engineering and stress testing tools before the physical chip is ever made.
Precisely. And this significantly enhances their moat. By offering solutions for the complete engineering spectrum, they become indispensable. You can see that in their partnership with NVIDIA, which is backed by a $2 billion investment.
And their innovation in AI-driven chip design.
Yeah, their Synopsys.ai tools have nearly 5,000 active users.
And their margin story looks pretty positive, driven by efficiency.
It is. They're projecting non-GAAP operating margin expansion to 40.5% in FY26.
Yeah.
And that's driven by disciplined cost management. They're doing a planned 10% workforce reduction, which shows a commitment to financial discipline as they integrate this huge ANSYS acquisition.
But, like the others, they have some clouds hovering over them. But these seem more geopolitical and legal, not financial.
That's the balance for Synopsys.
Yeah.
First, the geopolitical reality is hitting their bottom line. Revenue from the crucial China market was down a sharp 18% in FY25.
Because of export restrictions?
Export restrictions and just general geopolitical tensions. It's pushing customers there toward local competitive solutions, and Synopsys expects that to continue in FY26.
That's a persistent structural risk they can't easily solve. What about the legal pressure?
Yeah, the legal issue is concerning, and it's something to monitor. They're facing securities fraud, class action lawsuits over alleged IP underperformance during a period from late 2024 to September 2025.
And while those are just initial claims,
The distraction and the reputational risk alone are costly, especially for a company whose entire business relies on the integrity of its intellectual property.
so it's a specialized, high-moat business with excellent margin potential, but they're juggling significant geopolitical risk and legal scrutiny while integrating a major acquisition.
And internally, even their core design IP segment saw an 8% revenue decline in FY25. They're repositioning resources toward high-performance computing, which is the right long-term move, but it causes some short-term pressure.
Okay, let's step back and look at these three massive players side by side. If you're trying to process all this, the component supplier, the cloud builder, the design enabler, how do their financial and strategic pictures really compare right now?
We can summarize the trade-offs. For Broadcom, you have the strongest immediate financial reward. Immense AI backlog, superb cash flow, they're the high-margin supplier,
We
but...
have to accept the near-term margin risk and an extremely high valuation.
Exactly. For Oracle, you have massive potential future revenue. That historic RPO surge says it all. But they are sacrificing everything, especially free cash flow, for the CapEx needed to get there. The risk is all execution, high debt, volatility.
They have to deliver.
They have to deliver. And for Synopsys, they're strategically solidifying an already high-moat position with ANSYS, and they're showing excellent margin expansion potential. But their challenges are external.
Persistent geopolitical headwinds in China and those legal distractions.
Whereas the triangle.
So it really seems like which one is a better investment just depends entirely on your risk tolerance and your time horizon. Broadcom is the established player paying out now, but with valuation risk. Oracle is the high-risk, high-reward, future delivery bet.
And Synopsys is the specialized leader, offering efficient, if slightly bumpy, growth.
Each one gives you exposure to the AI boom, but through a fundamentally different financial structure and with a vastly different risk profile.
They really show how AI is restructuring balance sheets around the world.
So what does this all mean? The common thread is this non-negotiable, insatiable demand for AI capacity. But the financing strategies are dramatically different. You've got Broadcom managing its supply chain for immediate high-margin delivery today. You have Synopsys leveraging a huge acquisition to own the design flow tomorrow.
And Oracle is using massive debt and negative free cash flow, a huge gamble, to literally build the future cloud capacity right now.
Which model, the capital-heavy builder, the component supplier, or the design enabler, will yield the highest long-term returns as this AI bubble matures? I think that's the critical question.
And if you're trying to find the answer, you need to look very closely at the details of CapEx execution for Oracle. Are they meeting their build-out targets? For Broadcom, watch the margins. Is that component mix stabilizing? Those metrics, much more than just the initial revenue bookings, are going to determine success.
A fascinating comparison. Thank you for engaging with this deep dive, for navigating the silicon complexities and capital conundrums with us. If you found this useful, please remember to subscribe and hit the bell icon. It supports the channel and ensures you catch our next analysis.